3 weeks ago, on a Friday afternoon, when most people were planning their weekend, a document appeared in the Securities and Exchange Commission's filing system. Form 13F required disclosure for institutional investment. Managers with over $100 million in assets. Routine, boring, the kind of paperwork that gets skimmed by analysts and ignored by everyone else. Except this particular 13F wasn't routine. This one showed that the Bill and Melinda Gates Foundation Trust sold 2/3 of its Microsoft holdings in a single quarter. 2/3. Not a trim, not a rebalancing, a liquidation. And buried in that same filing period across dozens of other 13F forms submitted by Billionaire, controlled trusts, and family offices. A pattern emerged. A pattern so consistent, so coordinated, so utterly at odds with what these same billionaires are saying publicly, that it can only mean one thing. They know something. Something big enough that $89 billion in combined stock sales over the past 6 months isn't precaution, it's preparation. And the most terrifying part, nobody's talking about it. The financial media covers. Bezos selling 8.5 billion in Amazon shares. Like it's a tax strategy. They explain Zuckerberg dumping $500 million in Meta as estate planning. They rationalize Jaime Dimon's first JP Morgan stock sale in 19 years as routine diversification. But when you add it up, when you see Bill Gates quietly shifting his foundation's $37 billion portfolio out of tech and into trash collection, companies, railroads, and Berkshire Hathaway's cash pile. When you watch Warren Buffett sell stocks for 3 consecutive years while the market hits all-time highs. When you track Insider selling hitting levels not seen since 2007, right before the financial crisis, the message isn't subtle. It's screaming. The richest people on earth are exiting, and they're doing it now, while you're being told everything is fine. While CNBC runs segments about the soft landing, while your financial advisor tells you to stay invested for the long term, the smart money is moving quietly, methodically, with the kind of urgency that only makes sense if you know the ship is sinking. And today, January 19th, 2026, I'm going to show you exactly what they're seeing. Why 89 billion in insider sales is just the beginning, and why the assets they're buying, instead of stocks, should terrify anyone who thinks their retirement account is safe. Let me start with the numbers, because the numbers don't lie, even when everyone with a microphone does. According to data compiled from SEC filings between July 1st, 2025 and January 15th, 2026, a 6.5 month window, billionaire insiders across multiple sectors liquidated approximately $89 billion in publicly traded securities. That's verified. That's documented. That's not speculation or conspiracy theory. That's what they filed with the government under penalty of perjury. Now, 89 billion sounds abstract until you break it down by individual and realize these aren't random sales. These are concentrated exits. Jeff Bezos sold $8.5 billion in Amazon stock, 50 million shares. He did it in 9 trading days. Prior to 2019, Bezos had never sold more than $3 billion worth of Amazon shares in an entire year. $8.5 billion in 9 days. That's panic selling disguised as liquidity management. Mark Zuckerberg offloaded $500 million in Meta shares. Jaime Dimon, CEO of JP Morgan Chase, sold $150 million worth of the bank. He runs. First time he sold JP Morgan stock since 2005. Think about what that tells you. The man who has run JP Morgan for 18 years, who has access to every piece of economic data the bank collects, who knows exactly what's in the loan books. And the derivative positions decided after 18 years of holding that now, January 2026 is the time to sell. That's not retirement planning. That's exit planning. But here's where it gets interesting. The sales aren't uniform. They're targeted. Look at what they're selling. Technology, consumer, discretionary, financials. The 3 sectors that have driven the S&P 500 to record highs. The 3 sectors that represent the largest concentration of market capitalization. And look at what they're buying or holding instead. Bill Gates shifted his foundation's portfolio into Berkshire Hathaway, Waste Management, and Canadian National Railway. Boring. Defensive assets that generate cash flow regardless of whether the economy is booming or crashing. Warren Buffett's Berkshire Hathaway has been a net seller of equities for 3 consecutive years, selling more than buying. And what is Berkshire doing with the proceeds? Holding cash. Berkshire's cash pile as of the end of Q3 2025 was $325.2 billion. $325 billion sitting in treasury. Bills earning 5%. Not deployed stocks. Not acquiring companies. Just sitting there waiting for what? For the crash. Because when everything's on sale at 50% off, having $325 billion in dry powder lets you buy assets for pennies on the dollar. This is the playbook. Sell high, hold cash, wait for the panic, buy low. And if Buffett, who has preached buy and hold for 60 years, is selling stocks and hoarding cash, that tells you everything you need to know about what he expects to happen next. Now, let me address the official explanations, because the financial media has been working overtime to rationalize this. They say Bezos is selling for philanthropy. They say Zuckerberg is diversifying. They say Gates Foundation has to liquidate stocks to fund charitable giving. All technically true, but all deliberately missing the point. Because the question isn't why are they selling? The question is why are they selling now? Why not 2 years ago when valuations were even higher? Why not wait another year? If the economy is supposed to have a soft landing, the timing is the signal. And the timing says they're getting out before something breaks. Let me show you what they're seeing. Start with valuations. The S&P 500 is currently trading at 22.2 times forward earnings. That's a premium to the 5-year average of 20 and the 10-year average of 18.7. According to FactSet research, the S&P 500 has only sustained a forward price to earnings ratio above 22 during 2 periods in the last 40 years. The dot-com bubble from 1998 to 2000 and the co-pandemic stimulus bubble from 2020 to 2021. Both times the market crashed. The dot-com bubble popped in March 2000. The S&P 500 fell 49% peak to trough. The CO bubble deflated in 2022. The S&P 500 fell 25%. Right now, we're back above 22 times forward earnings, and the billionaires are selling. That's not a coincidence. That's pattern recognition. Second signal, earnings. Growth is decelerating. Microsoft, the largest component of the S&P 500 by market cap, reported revenue growth of 16% year over year in its most recent quarter. That sounds strong until you realize that free cash flow, the actual cash the company generates, fell 7%. Why? Because Microsoft is spending tens of billions on AI infrastructure, data, centers, GPUs, servers. They're betting that AI will generate returns that justify those investments. But what if it doesn't? What if AI turns out to be another blockchain, another metaverse, another overhyped technology that burns capital and never delivers the promised profits? The billionaires aren't waiting to find out. They're selling while AI hype keeps valuations elevated. Third, signal, concentration risk. The top 7 stocks in the S&P 500, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla account for 32% of the index. 32% of the entire market's value is concentrated in 7 companies. That's the highest concentration since the Nifty 5 era of the 1,970 seconds. And we know how that ended. When the market turned, those 7 stocks didn't just underperform, they collapsed. Because when everyone owns the same thing, when passive index funds are forced to buy more of the biggest stocks because of their weighting, the flow becomes self-reinforcing on the way up. But it becomes self-destructive on the way down. When selling starts, index funds have to sell the largest holdings first to raise cash. That pushes prices down, which triggers more selling, which pushes prices down further. It's a liquidation cascade, and the billionaires see it coming. Fourth, signal, credit markets are tightening. Corporate debt to GDP in the United States is at 110%, higher than it was before the 2008 financial crisis. Companies borrowed trillions at near zero interest rates during COVID. Now, rates are 3.5 to 3.75. Debt that was rolled over at 1% in 2020 is getting refinanced at 4% in 2026. That's a 4 times increase in interest expense. Companies that were profitable at 1%, rates are suddenly unprofitable at 4% rates. Bankruptcies are rising. High yield credit spreads are widening. The bond market is pricing in defaults. And the billionaires who have access to private credit markets and can see which companies are struggling to refinance are getting out of equities before the credit contagion spreads. Fifth signal, insider selling ratios. The ratio of insider sells to insider buys hit 4.7 to 1 in December 2025. That means for every share that corporate insiders bought of their own companies, they sold 4.7 shares. That's the highest ratio since 2007, right before Lehman Brothers collapsed. Insiders, the CEOs and CFOs and board members who know their businesses better than anyone are, selling, not buying. They're supposed to be bullish. They're supposed to believe in their companies, but they're selling at near record rates. And retail investors, the ones who don't have inside information, are buying through 401k contributions, through index fund purchases, through ETFs. The dumb money is buying what the smart money is, dumping. That's the setup for every market crash in history. Now, let me show you what Bill Gates specifically is doing, because his moves are the most telling. The Gates Foundation Trust portfolio as of September 30th, 2025, the most recent 13F filing, was valued at $36.58 billion, down from over $48 billion earlier in the year. Where did the money go? It was liquidated, converted to cash, donated to the foundation's operating budget. But here's what's important now to the composition of what remains. Microsoft used to be 28.6%, 6% of the portfolio. After the Q3 2025 sales, it's down to 12.8%, a 55% reduction in Microsoft weighting. And Microsoft isn't a bad company. It's one of the best run, most profitable tech companies on earth. But Gates is selling it anyway. Why? Because even great companies aren't worth owning at 40 times earnings when the market is about to reprick. Instead, Gates increased his holdings in Berkshire Hathaway, Waste Management, and Canadian National Railway. Let me explain why those three matter. Berkshire Hathaway is Warren Buffett's conglomerate. It owns insurance companies, railroads, utilities, manufacturers, and a massive stock portfolio. But most importantly, it's sitting on $325 billion in cash, buying Berkshire, effectively buying a cash proxy with optionality. If the market crashes, Berkshire deploys that cash to buy assets cheap. If inflation accelerates, Berkshire's tangible businesses generate pricing power. If the economy enters recession, Berkshire's diversified revenue streams provide stability. It's the ultimate defense of holding. And Gates is loading up on it. Waste Management. It's a trash collection company. Boring, unsexy, but essential. People produce garbage, regardless of whether the economy is booming or crashing. Waste Management has a near monopoly in many regions because the regulatory barriers to building landfills are insurmountable. No new competitor can enter. And Waste Management generates steady cash flow with pricing power. When costs rise, they raise rates. When the economy slows, trash volumes don't decline significantly. It's recession proof, and Gates holds over $7.5 billion worth. Canadian National Railway, another boring essential asset. Railroads move freight, coal, grain, oil, containers. As long as the economy functions, railroads are needed. Canadian National operates the only transcontinental rail network in North America that connects three coasts. It's irreplaceable infrastructure, and it generates predictable cash flow. These aren't growth stocks. These aren't AI plays. These are bunker assets. The kind of investments you hold when you expect turbulence, when you expect the glamorous stuff, the tech stocks, the high F flyers to get obliterated. Gates is positioning for a world where dividends matter more than growth, where tangible assets matter more than intangible hype, where survival matters more than speculation. That's the 89 billion warning. Now, let me show you what Buffett has been doing, because Buffett's actions are even more extreme. Berkshire Hathaway's equity portfolio as of September 30th, 2025 was valued at $266 billion, down from over $350 billion at the peak. Buffett has been selling equities aggressively. His largest sale was Apple. Berkshire reduced its Apple position by approximately 15% in Q3 alone. Apple used to be 50% of Berkshire's equity portfolio. It's now down to approximately 30%. And Buffett loves Apple. He called it one of the best businesses in the world, but he's selling it anyway. Why? Because Apple is trading at 33 times earnings. And no matter how great a business is, valuation matters. At 33 times earnings, Apple's stock price is pricing in perfection. Any disappointment, any revenue miss, any margin compression, and the stock gets hammered. Buffett is selling while it's still expensive, and he's not replacing it with other stocks. He's holding cash, $325 billion in cash and treasury bills, earning 5% risk-free. That's not bullish behavior. That's defensive behavior. That's someone who expects the market to offer better opportunities at lower prices in the near future. And Buffett has said publicly in his annual letters and in interviews that he struggled to find attractively priced investments. The market is too expensive. Private equity is too expensive. Acquisitions are too expensive. Everything is overvalued. So he's waiting. And while he waits, he's selling, raising cash, building ammunition for the moment when fear replaces greed and assets get cheap again. Now, let me connect this to the macro environment, because individual insider sales don't happen in a vacuum. They happen against a backdrop of economic conditions that smart money can see developing. And right now, the backdrop is deteriorating. Start with the labor market. The unemployment rate ticked up from 3.6% in April 2025 to 4.2%. 2% in December 2025. That's a 0.6 of a percentage point increase in 8 months. Sounds small, but the SAM rule, a recession indicator developed by economist Claudia S., says that when the 3-month moving average of the unemployment rate rises by half a percentage point or more relative to its low in the previous 12 months, the economy is in a recession. We just triggered the SAM rule. The unemployment rate has risen by 0.6 from its low. According to historical data, every time this indicator triggers a recession, either has already started or is imminent. The billionaires see the labor market weakening. They see layoffs accelerating in tech and finance. They see job openings declining, and they're selling equities before earnings collapse. Second, macro signal, consumer spending is faltering. Credit card delinquency rates hit 6.8% in Q3 2025. That's the highest level since 2011. Auto loan delinquencies are at 5.6%. The highest since 2010. Americans are struggling to pay their debts. And when consumers are maxed out on credit and can't borrow more, spending declines, 70% of the US economy is consumer spending. If that drops, GDP drops, corporate revenues drop, earnings drop, stock prices drop. The billionaires see the consumer weakening. They see savings rates at 4.4%, the lowest in decades. They see household debt at 18.59 trillion, and they're exiting before the consumer breaks. Third macro signal, commercial real estate is in free fall. Office buildings in major cities are worth 30 to 50% less than they were in 2019. Not because of temporary COVID disruptions, because remote work is permanent. Companies don't need as much office space. Tenants aren't renewing leases. Buildings are sitting vacant. And the loans backed by those buildings, the commercial mortgage-backed securities are starting to default. Banks that hold those loans are facing losses, regional banks especially. And when banks face losses, they tighten lending. When lending tightens, economic activity slows. And when economic activity slows, earnings fall and stock prices follow. The billionaires see the commercial real estate crisis. They see the hidden leverage in the financial system. And they're selling before the contagion spreads. Fourth macro signal, geopolitical instability. Wars in Ukraine and Gaza. Tensions between the US and China. Tariffs, trade, restriction, sanction, deglobalization. Every one of these factors increases costs, disrupts supply chains, and reduces corporate profitability. And the billionaires who have access to intelligence briefings and private geopolitical analysis know that tensions are escalating, not de-escalating. They're positioning for a world where globalization reverses, where supply chains fragment, where nationalism trumps efficiency. And in that world, the companies that thrived under globalization, the Apples and Nikes and Starbucks, face margin compression. The billionaires are front running that reality. Fifth macro signal. The AI bubble is showing cracks. Microsoft, Amazon, Google, Meta, they've collectively spent over $200 billion on AI infrastructure in the past 2 years. Data centers, GPUs, energy, and what have they gotten in return? ChatGPT, Copilot, Gemini tools that are impressive but not yet profitable at scale. The revenue from AI products doesn't justify the capital expenditure. Not yet. Maybe not ever. And investors are starting to ask questions. When does AI become accretive to earnings? When do these investments pay off? The billionaires aren't waiting for answers. They're selling while the hype keeps valuations elevated. Because if AI turns out to be overhyped, if the returns don't materialize, the stocks that have led the market higher, Nvidia, Microsoft, Amazon, they'll be the ones that fall the hardest. Now, let me show you the timeline, because this isn't a distant threat. This is imminent. Phase 1, we're in it now. January through March 2026. Insider selling continues. Retail investors keep buying. The S&P 500 stays near all-time highs.